Go.
Hi, this is Rob Sitigatpour from Stratco Property Solutions. I'm back today with my partner, Mitch Flaherty from B6 Real Estate for the latest market update. Today's conversation, we're going to be discussing the 2020 presidential election and its proposed impact on taxes and its relationship to real estate investments. We're going to be discussing both plans later on in the presentation. We're joined today by two specialists in this field. First is John Boykus from Rake, and if I pronounce this incorrectly, please forgive me. Raish, Ende, and Malter, their middle market accounting firm. John specializes with the real estate industry, and also Jeff Feinstein, who's a financial advisor for many in the industry. Mitch, I'll let you take it from here with our initial questions.
Sure. Thanks, Rob. Thanks, John and Jeff, for being here today. We really appreciate your time and your insights. It's certainly very topical at the moment. So, John, the first question I had for you was that Congress have passed a number of bills released recently in relation to the COVID-19 pandemic. Just curious as your thoughts how these new laws have affected the real estate industry.
Well, the biggest thing that Congress passed was the Paycheck Protection Program, which was intended to help businesses pay employees, even though the pandemic caused many businesses either cut back substantially or shut down. The way the PPP was structured was that the government would loan money to businesses. However, if that money was used for the government's dictated intentions, the business would never have to repay that money. The chief intention of the government was to pay employees, to continue people on the payroll so that they didn't go on unemployment. However, the law allowed 40% of the loan proceeds to be used for rental of business property. So right there, if tenants are not paying you, the landlord should really look into the fact that if the tenant received PPP money, you need to advise them that the payment of rent would qualify for forgiveness from the government and they wouldn't have to repay it.
Okay, great. So have there been any other tax advantages that would affect the real estate community?
Well, there's been several changes, but the most important one, I believe, is what's known as Qualified Improvement Property, or QIP. The QIP is defined as any improvement to the interior of a non-residential building that is done after the building is originally placed in service. In effect, we're talking about interior improvements to an existing building. The Tax Cut and Jobs Act of 2017 allowed for 100% bonus depreciation for these assets with a life of 20 years or less. Unfortunately, the way the law was written, it was written so fast that they forgot to include qualified improvement property as being eligible for this. The 2020 CARES Act corrected that retroactively, and now any kind of tenant fit up or any kind of interior construction to a non-residential building can be expensed directly, and that goes for 2018, 2019, as well as 2020.
Okay, great, thank you. Rob, are you moving on to the next question?
Yeah, Jeff, what do we do from a financial planning perspective to basically prepare ourselves for those that are in real estate?
And it's a great question, especially when it comes to legislation and tax law. And I have a client, he's in real estate, and he always uses levity whenever we speak. And he said, everyone jokes, the only two certainties in life are death and taxes. And he jokes that one of those two things I can control. The four things that really people look at when there's a change of presidency are they look at long-term capital gains and the tax treatment that might come with selling a property. They look at step up in basis. So if and when they pass away and they pass the asset on to a future generation, what the tax ramifications are. They look at 1031 exchanges and how that works if they were to sell a building with Mitchell and buy a new building. And then the fourth thing that is, I think, top of mind for everyone is estate tax exemption. So for families that have a certain net worth, if there was a change of presidency, they should be aware of there are some planning moves to make that might protect their property if they were to leave it to the children or a trust or whatever it might be.
Okay, great. Can you elaborate a bit further on what that means for real estate owners at the moment? Yeah,
it's a great question. So let's say you own a building that's worth $40 million in Brooklyn or Manhattan, whatever it might be. Right now, with the current administration of the current tax code, you and your spouse can leave up to $11 million apiece to your children tax-free. So $11 million times 2 is $22 million. So the tax liability would be about $18 million in that $40 million property. If the exemption were to go from 22 million down to $5 million a parent or $10 million, whatever it might be, then there could be significant tax liability. So those in real estate really need to prepare for, if something were to happen, that they need liquidity in their lives to be able to pay tax liability so that future children aren't forced to sell a property just to pay tax liability in an environment that might be as advantageous. Okay, great. So I've just pulled up the chart here comparing both the current law and the Biden and Trump tax plan. John,
So let's first give a disclosure here. So we're politically agnostic. We're not advocating for any political leanings, but more so for all of us in the community to prepare and to be aware of what's being proposed, what the current legislation is, and so we can prepare our businesses for various scenarios. And also what we may be sharing may be subject to error or change. This is just based off of our findings. John, let's start with you. So we basically outlined various tax areas, the current legislation, and then the proposed plan from both of the political parties. Can you just walk us through high level of what we're seeing here?
Well, you can see that where the current law sits, and that's pretty much been the result of the 2017 Tax Cut and Jobs Act. Vice President Biden has made several statements, none of which are obviously binding on him, but he is talking about increasing the top tax rates on individuals, raising the tax rates on dividends and long-term capital gains, corporate taxes. One of the serious things that he's talking about is eliminating the 1031 like-kind exchange for anyone that earns more than $400,000 a year. This is a crucial item for the real estate business because it allows owners to swap out properties and, in effect, retain all the selling price as long as it's invested in another property.
John, that's off of earned income, right? That's not investment income.
That's totally any income is what it's talked about.
Yeah, just to jump in with a comment there, I think that investors will definitely be paying close attention to the 1031 exchanges because that's one of the major drivers that fuels the New York City, volume and buying and selling of real estate.
Jeff or John, how do you think the changes with the 1031 may impact sales or strategy for owners or buyers?
Jeff,
I think that's more of a question for Mitchell, because I'm sure he's having a lot of conversations with clients that are maybe expediting, maybe selling a property to do some sort of 1031 exchange. But I think from my perspective, it's more about people are doing more planning around when they buy a property or sell a property, how it's owned, who it's owned by. Because most people, they invest in real estate not for short term, they invest in real estate for long term. They invest in real estate for their family, for their kids. So I see it as something that's more of a long-term hold when you think about the tax ramifications, but I don't know what the immediate impact would be when it comes to the real estate market in some of these metro areas.
Yeah, if you look at previous cycles and when there's been increases in capital gains, you've seen a significant surge in activity of, trades with sellers that obviously don't want to pay the higher tax rate. So that may, come into fruition. Who knows? No one has a crystal ball. But I think if 1031s were eliminated completely, I think there'll be less transactions in the market because, they can't defer that gain.
So one thing to add here, just as a disclosure, even though one of these parties may win the executive branch, we also have to see who's going to be in power with both on the two legislative ends, because it's going to be a majority amongst the three. So we shouldn't just focus on the executive as we're planning for these scenarios. We should keep that in mind. Question for John. When would be the earliest some of this stuff may come into effect?
Well, as you just stated, that regardless of what any president wants, it still has to be passed through the legislature. When the 2017 Tax Act was passed, it was passed late in December. It took a full year of negotiating and moving it through Congress. And that was even when the Republicans had both the House and the Senate to come to an agreement. The effective date on that law was primarily December 1st, January 1st, 18, although some things refer to the last quarter of 17. So, if Congress can get past the act quickly, it might take an effect in, retroactively to January 1st of 2021. But, it's hard to say.
Okay, great. I think that concludes today's session. There's a lot to discuss there. We'll have to get together again in 2-3 months' time and see what the outcome may be. Thank you for your time again. Really appreciate it. I'll just share our contact information now in case anyone wants to reach out with any further questions. There you go. Take care and I'll speak soon, everyone. Thank you.